Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we take a look at a different aspect from the world of investment and attempt to draw conclusions based upon the rules laid down by the man widely considered to be the father of the craft. Teacher and mentor to Warren Buffett, we're of course talking about Benjamin Graham. In this edition, we should be looking into the fine art of knowing exactly when is the right time to sell out your holdings in a particular business. This could be about cutting your losses or because you believe that the company no longer is the bargain it once was, and now might be the time to take your profits. We will consider and conclude how exactly we can determine as value investors when is the right time to sell out your position at a profit, but also potentially at a loss, in order to prevent even steeper losses. So without further ado, let's get right on with it. As ever, sit back, strap in, and get ready to take on board another lesson in the art of value investment as inspired by Benjamin Graham. One of the things that value investors always like to preach about is that we are in it for the long haul. If we are to buy a stock, our ideal holding period is forever. We are actually quite tight like that. We don't like paying trading fees or capital gains taxes if we don't have to. But in reality, not many businesses are going to continue to be a bargain forever. At some point in the future, if we've been any good at all with our selections, stock prices should rise from the bargain basement prices that we've purchased them at to a level that offers fair value and ultimately to a point where the stock seems overpriced. Since none of us want to be holding stocks that we believe are trading at levels more than they're actually worth, this inevitably means that at some point we're going to have to make the tough decision to sell out our positions. In actual fact, picking out the right point to sell when stock prices have increased should, in theory at least, be a relatively simple matter. That is, if we face the problem objectively. At the time of purchase, we would have had a good idea what the fair value of that stock would look like. And after the purchase, we should naturally have been keeping an eager eye to ascertain if this fair price point has altered in any way. This may mean adjusting the outlook as new quantitative data has arrived. That, of course, doesn't mean checking its price every day or every hour for that matter, nor does it mean searching the internet for anything that anyone has said about the stock. But it does mean at least taking a glance at the latest price from time to time, checking for any large swings in price that may lead you to the conclusion that now might be the right time to take your profits. With these factors met, the time to sell should be pretty straightforward to determine. And that time should be when the price has risen to somewhere in the vicinity of our currently gauged range of fair value. There are a number of things, however, that can complicate this rather simplistic conclusion. One of them being quite illogical, the other a little more rational. The illogical reason that might lead us to staying on for too long is driven purely by emotion. I know it to be true from personal experience that selling out a long-held position can sometimes be quite affecting. There is no doubt about it that you can become quite sentimental towards a business that you've been involved in for many years, and selling out can involve a sort of mild mourning process. You may well have been watching and caring about a particular business for years, and suddenly dumping it by the wayside can evoke strong emotions. Of course, it is a totally illogical response, but ultimately we've been trained as value investors to consider ourselves to be part owners of any business that we hold stock in. So just as owners of private businesses often want to hand the reins over to their sons or daughters rather than selling out to complete strangers, they, like us, can sometimes struggle to let go. This, needless to say, is an emotion we need to overcome pretty quickly and not let it stand in the way of selling out when the facts demand it. Holding on out of sentimentality can be an expensive business. The more logical reason we may want to sell out prior to a stock reaching its fair value is because better opportunities may have arisen elsewhere. The capital available to invest in stocks as an investor will always be finite, of course. So unless you're Warren Buffett's Berkshire Hathaway, who always seem to have a cash pile of several $100 billion on hand, this means that sometimes an opportunity will arise that is just too good to miss out on. At this point, it may very well make sense to sell out of one of your other positions before it has reached its level of fair value, in order to take up this new opportunity. In this instance, you will have adjudged that the potential of much better returns with the new opportunity outweighs the returns available from waiting for your currently held stock to reach its full return potential, taking into account fees and any other potential tax implications. This, of course, makes the right time to sell a stock more of a juggling act and less straightforward than it might otherwise have been. We have so far considered when is the correct time to sell out of our profitable positions, but what about selling out of our unprofitable ones? The fact is that no matter how good we are as value investors, from time to time we're going to screw up quite royally. This might occasionally be factors of our own doing. We may have made a mistake with our quantitative analysis, or failed to realise that there were qualitative factors at play that had invalidated the very conclusions we had drawn from the financial showing. Alternatively, it may be that, despite our very best efforts, something completely unforeseeable has cropped up that has destroyed our sound rationale for purchase. It would have been beyond the scope of the average value investor to have foretold the accounting scandals at Enron or WorldCom, for instance. Some things are just beyond our reasonable control. This means that occasionally we will be forced to bite the bullet and do the very thing we hate the most, selling out at a loss. However, here a number of psychological factors can come into play that prevent us from doing the sound and intelligent thing. If the factors that have altered the outlook are something short of an accounting scandal, then we can sometimes talk ourselves into the fact that the new information that has become evident fails to fundamentally change the conclusions that we've already drawn. Value investors hate being wrong, and if we're not careful, this can cause us to hold out longer than we really ought to, and in doing so we run the risk of compounding our losses. The secret here, sometimes much easier said than done, is to impassionately reevaluate the situation on the basis that the stock is not currently held. Would you buy that stock at that price today? And if the answer is no, then that stock should be sold. It does seem to me to be true that selling out at a loss when the fundamental picture demands it is something of a weak point for us as value investors. Investors following other approaches do seem more disposed to getting rid in a much more timely manner. This may be down to our emphasis on the historical financial results from which we draw our conclusions, with the qualitative factors being much more of an add-on or an auxiliary to this. Turning economic tides do nothing, of course, to alter past financial records, except in the instance of financial fraud, of course. But altering long-term outlooks tend to be related more to the qualitative factors at hand, something other types of investors tend to place more emphasis upon. This can leave us hanging on for too long when the long-term outlook genuinely has altered for the worse. Airline stocks took a beating in early 2020 as coronavirus swept the world. Other investing disciplines who place prime emphasis on the qualitative outlook would likely have been startled by the situation long before we as value investors took notice. We had our historic accounts to rely on, which looked pretty good, thank you. So why would we sell out on the basis of something that would probably turn out to be no more serious than swine flu? But of course the strength of the accounts did nothing to protect us as things turned out, and most of us likely held on too long. So what's the solution, I hear you cry? The best we can hope to do is simply to ensure that we never let pride get in our way when we have truly determined that the financial reality has changed for good, and fight our instincts to believe that every investment needs to net us a profit. Selling out on the basis of an altered qualitative picture will not be easy, nor will it be an exact science. We may well have been late to leave the party in the instance of the airline stocks in 2020, but the pandemic was a highly unusual and unknowable affair. But clearly at some point it would have started to become pretty obvious that the single factor of the epidemic would completely demolish the conclusions drawn from our study of the historical accounts. At this point, whenever it may have been, the value investor should have sold out, but many didn't, including me. A reminder once again that airline stocks are not historically kind to investors. As Warren Buffett once put it, if a capitalist had been present at Kitty Hawk back in the early 1900s, he should have shot Orville Wright. On that note, I shall draw this edition of Intelligent Investment Today to a close. I do hope you've enjoyed it. If you have, please do consider adding to playlist. That way you'll be notified whenever a new edition lands on the platform. And please do continue to spread the word. That way we can make this as large a community of like-minded investors as is possible. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.